Before we dive in, please remember that I am not a financial advisor, attorney, or mortgage originator. This video is for informational and educational purposes only and should not be considered legal or financial advice. The world of mortgages is complex and highly regulated. Always consult with a qualified professional, like a licensed mortgage loan originator and a real estate attorney, before making any financial decisions. Your financial situation is unique, and the information presented here may not be suitable for your specific circumstances. Imagine this for a second. A young couple, let's call them Mark and Sarah, did everything right. They saved for years, got their credit scores into the high 700s, and landed a pre-approval letter from their bank that felt like a golden ticket. They spent months searching, losing bidding wars, until finally, they found it. The perfect house. A little Cape Cod with a big backyard for their dog. They put in an offer, it was accepted, and they were ecstatic. They paid for the inspection, the appraisal came in great, and they wired their $5,000 earnest money deposit. They were already picking out paint colors, arguing about where the couch should go. They were 1 week from closing, 1 week from getting the keys to their future. And then the phone rang. It was their loan officer. The tone was all wrong. There was a problem. A tiny, insignificant student loan that was in deferment had been calculated incorrectly by the underwriting software. It was a detail buried on page 47 of a document they'd never even seen. The new calculation pushed their debt-to-income ratio just a fraction of a percentage point over the maximum limit. The final loan approval was denied. The deal was dead. Just like that, their dream evaporated. They lost the house. And because they were past their financing contingency deadline, they lost their $5,000. That story isn't just a nightmare scenario. It is a reality for thousands of American families every single year. And it almost never has to do with the house itself. It has to do with a fundamental misunderstanding of the complex, and frankly, intimidating legal system that underpins every single mortgage in the United States. Most of us focus on the interest rate, the down payment, the monthly cost. But the most expensive mistakes, the ones that cost you your dream home and your hard-earned savings, are hidden in the legal framework. That is going to change for you right now. In this presentation, we are pulling back the curtain on the 5 most critical U.S. mortgage laws and legal concepts that every single homebuyer needs to understand. This isn't boring law school theory. This is your financial armor. This is the knowledge that separates a smooth, successful closing from a last-minute catastrophe. We are going to break down, first, the ability to repay rule, the single most important consumer protection law passed in the last 50 years, and how you can use its requirements to spot a predatory lender a mile away. Second, we'll demystify the TILA-RESPA Integrated Disclosures, or TRID. We're going to translate the 2 most important documents in the entire process, the loan estimate and the closing disclosure, and show you the exact red flags that should make you slam on the brakes. Third, the Fair Housing Act. This is more than just a poster in an office. We'll cover how to recognize subtle, illegal discrimination that can get your application unfairly denied, and exactly what your rights are. Fourth, the critical concept of lien priority. This sounds complicated, but it's a simple idea that determines who gets paid first if things go wrong. Understanding this is the key to knowing why title insurance isn't just a junk fee. It's a non-negotiable shield. And finally, number 5, the right of rescission. This is the secret undo button that the law provides for certain types of loans, giving you the power to cancel the entire deal, even after you've signed everything, and we'll explain exactly when and how you can use it. By the end of this, you won't just be a home buyer. You will be an informed, empowered, and protected consumer, ready to navigate the biggest financial decision of your life with confidence. So let's start with the big one, the absolute bedrock of modern mortgage lending, the ability to repay rule, or ATR. To understand why this law is so important, we have to take a quick trip back to the mid-2000s, right before the 2008 financial crisis. Back then, the mortgage world was the Wild West. You had lenders handing out what were infamously known as ninja loans. That stood for no income, no job, or assets. Seriously, lenders were giving out hundreds of thousands of dollars to people without verifying if they could actually pay it back. They were selling adjustable rate mortgages with teaser rates that would eventually explode, and loans that didn't even require you to pay down the principal. It was a house of cards built on reckless lending, and when it all came crashing down, it took the global economy with it. Out of the ashes of that crisis, Congress passed the Dodd-Frank Act, a massive piece of financial reform. And buried inside that act was the creation of the ability to repay rule, which officially went into effect in 2014. Here's what it says in plain English. A lender cannot give you a mortgage without first making a reasonable, good faith determination that you have the ability to repay the loan. They can't just guess. They can't just take your word for it. They have to do their homework. They have to collect documents, verify information, and build a case file that proves you can handle the financial responsibility you're about to take on. This rule fundamentally shifted the legal burden. Before ATR, if you defaulted, the blame was entirely on you. After ATR, if a lender gives you a loan you clearly couldn't afford from the start, they share in the legal responsibility. It was a seismic shift designed to protect you, the consumer. So how do they do it? The law is very specific. It requires lenders to consider, at a minimum, 8 specific underwriting factors. Let's quickly walk through them, because this is the checklist your lender is using right now. 1. Your current or reasonably expected income or assets. They need to see pay stubs, W-2s, tax returns, and bank statements. They're not just looking at the number. They're looking for consistency and stability. 2. Your current employment status. Are you a salaried employee with a 10-year track record? Or a freelance contractor who just started a new business? Stability is the name of the game. 3. The monthly payment on the mortgage you're applying for. This isn't just the principal and interest. It includes property taxes and homeowner's insurance, what's known as PITI. 4. The monthly payment on any simultaneous loans secured by the same property. This targets the old piggyback October 10th, 80 loans where people would take out a second mortgage to cover the down payment. Lenders have to count that second payment too. 5. The monthly payment for mortgage-related obligations. Think homeowners association fees or HOA dues. These are mandatory payments tied to the property, and they absolutely count. 6. Your current debt obligations. This is everything else. Car payments, student loans, credit card debt, alimony, child support. They pull your credit report and add it all up. 7. Your monthly debt-to-income ratio or DTI. This is the magic number. They take all of your monthly debt payments, including your new potential mortgage, and divide it by your gross, pre-tax monthly income. While there's no single legal limit, a common benchmark for many loans is around 43%. And 8. Your credit history. They're looking at your score, yes, but also the story behind it. A history of on-time payments is gold. A recent bankruptcy or foreclosure is a major red flag. Now, here's the most important part of all this. When a lender follows these 8 steps and gives you a standard, safe, fixed-rate mortgage with predictable payments and no crazy features, that loan is typically considered a qualified mortgage, or QM. Think of a qualified mortgage as a stamp of approval. It's the gold standard. A QM loan is legally presumed to have complied with the ability to repay rule. This gives the lender a safe harbor from lawsuits. But more importantly, it gives you, the borrower, immense protection. If you get a QM loan, you can be highly confident that the loan is affordable and its terms are stable and transparent. So, what is the actionable takeaway for you? When you're applying for a loan and the lender asks for what feels like an invasive mountain of paperwork, every pay stub since you were born, 2 years of tax returns, 3 months of bank statements where they question every single deposit, do not get frustrated. You should get excited. That lender is doing their job. They are meticulously following the ability to repay rule, the very law designed to protect you from financial ruin. They are building the case for a safe, stable, qualified mortgage. The real red flag, the siren blaring 5-alarm fire, is the lender who doesn't ask for this stuff. The one who says, "Oh, don't worry about that, we can do a stated income loan," or "Just tell us what you make, we're flexible." That is a lender who is actively trying to skirt the most important consumer protection law on the books. They are not doing you a favor. They are putting you and themselves at massive risk. Thanks to the ATR rule, you now know that a thorough, detail-oriented lender isn't being difficult. They're being compliant. And that compliance is your first and most powerful line of defense. But that defense, that legal shield, doesn't just cover whether you can afford the loan month to month. It also protects you from one of the most terrifying moments in the home buying process, the closing table ambush. Imagine this for a moment. You've spent months, maybe even years, saving for a down payment. You've found the perfect house. You've navigated inspections, appraisals, and endless paperwork. The moving truck is booked. You walk into the title company's office, your hand ready to sign the final papers, your heart pounding with excitement. And then they slide a document across the table. The final number, the amount you need to bring to closing, is thousands of dollars higher than you were told. Panic sets in. The closing agent looks at their watch. The sellers are tapping their feet. The real estate agents are exchanging nervous glances. You're told these are just standard fees. What do? You feel trapped. If you walk away, you could lose your deposit, the house, everything. So you sign. You drain your emergency fund, maybe even borrow from a relative, and walk away from your dream come true moment feeling violated, confused, and broke. For decades, this was a grim reality for countless American homebuyers. The system was a confusing mess of different forms with different names like the good faith estimate and the truth in lending disclosure. They were dense, hard to compare, and filled with loopholes that allowed for last-minute surprises. It was a system that thrived on confusion, but after the 2008 financial crisis, lawmakers looked at this broken process and said, "Never again." The result was our second critical piece of mortgage law, the TILA-RESPA Integrated Disclosure Rule, or TRID. You might hear it called the Know Before You Owe rule, and that name tells you everything you need to know about its mission. TRID's genius was its simplicity. It threw out the old, confusing forms and replaced them with just two standardized, easy-to-read documents: the loan estimate and the closing disclosure. These two documents are your sword and your shield in the fight for transparency. Let's start with the loan estimate, or LE. This is your price quote. By law, a lender must send you this form within 3 business days of you submitting a loan application. This isn't a vague worksheet. It's a 3-page, federally standardized document that breaks down the entire loan offer in plain English. Every lender uses the exact same form. This is a game changer. For the first time, you could take the loan estimate from lender A and lay it right next to the one from lender B and compare them apples to apples, line by line. The loan estimate clearly shows your interest rate, your monthly payment, and whether those can change over time. It estimates your property taxes and homeowner's insurance, giving you a real sense of your total monthly housing cost, not just the principal and interest. But its most powerful section is the breakdown of closing costs. It separates them into clear categories: origination charges from the lender, services you can't shop for like the appraisal, and services you can shop for, like title insurance. It gives you an all-in cash-to-close estimate right there on page 1. This document single-handedly destroyed the "let's just hide the fees and hope they don't notice" business model. Now you might be thinking, that's great, but it's just an estimate. What stops them from changing the numbers later? This is where the real teeth of the TRID rule bite down. The law sets strict limits, or tolerances, on how much these estimated fees can change by the time you get to closing. Certain fees have zero tolerance. That means they cannot increase by a single penny from what's on your loan estimate. These are the fees the lender has direct control over, like their application fee, their underwriting fee, or the cost of discount points you pay to lower your rate. What they quote you is what you pay. Period. Next, there's a category with a 10% cumulative tolerance. This bucket includes fees for third-party services that the lender requires you to use, or that you choose from their approved list. Think of things like the appraisal fee, the credit report fee, or the title company's settlement fee. The cost of any one of these individual services can go up or down slightly, but when you add them all up, the total cannot be more than 10% higher than the total estimated on your loan estimate. This prevents a lender from death by 1,000 cuts, where they lowball a bunch of small fees that suddenly balloon at the end. Finally, there are fees with unlimited tolerance, but don't let the name scare you. These are for services you have the right to shop for independently, like your homeowner's insurance or a pest inspection. The law gives you the freedom to choose your own provider, so the lender isn't held responsible if your choice costs more than their initial estimate. It also includes things like prepaid property taxes, which the lender has no control over. The key here is that the loan estimate empowers you by showing you exactly which costs you can control and save money on by shopping around. So the loan estimate gives you the clear upfront quote. But the final knockout punch to closing table surprises is the second document, the closing disclosure, or CD. The closing disclosure is the final bill. It's a 5-page document that looks very similar to your loan estimate, and that's by design. It provides the final actual figures for your loan. And here is the most important part. By law, you must receive your closing disclosure at least 3 full business days before your scheduled closing. Let that sink in. The days of seeing the final numbers for the first time at the signing table are over. That 3-day review period is your legally protected time to sit down, without pressure, and compare your closing disclosure line by line with your original loan estimate. You get to be a detective. You check the interest rate. You check the loan amount. You check every single fee. And if you find a discrepancy, if that zero-tolerance origination fee is suddenly $50 higher, you don't have to argue about it under pressure in a stuffy conference room. You call your loan officer from the comfort of your own home and say, "Page 2 of my CD doesn't match page 2 of my LE. The law says this fee can't change. Please fix it." And they have to. If significant changes are made, like a switch in the loan product or the addition of a prepayment penalty, it can even trigger a new 3-day review period, giving you more time to be sure. This law fundamentally shifted the balance of power. It takes the pressure cooker environment of the closing table and defuses it days in advance. It forces transparency and accountability. Thanks to TRID, the closing table ambush is, for any compliant lender, a thing of the past. Your loan estimate is the promise, and your closing disclosure is the proof, with a 3-day window to make sure the promise was kept. So while the ability to repay rule protects you from a loan you can't afford long-term, the TRID rule protects you from being bled by 1,000 hidden cuts on your way to the front door. It ensures the price you were quoted is the price you actually pay. But there's another, more sinister danger that these financial regulations alone can't address. It's a risk that has nothing to do with your income or the lender's fees, but with something far more personal. It's the risk of being denied your dream not because of your wallet, but because of who you are. And the laws that fight this injustice form the very bedrock of fairness in American housing. That bedrock of fairness is built on 2 monumental pillars of American law: the Fair Housing Act and the Equal Credit Opportunity Act. These aren't just dusty old statutes. They are living, breathing shields that protect your dream of homeownership. To understand their power, we have to step back in time, to an era when a red pen could destroy a family's future before it even began. Imagine a map of a major American city in the 1940s or 50s. Now, imagine bankers and government officials drawing lines on that map. They circle entire neighborhoods in red ink. This was a practice called redlining. If you lived inside one of those red lines, you were deemed too hazardous for a loan. It didn't matter what your income was. It didn't matter if you had a perfect payment history or a stable job. The decision was made for you based on one thing: the racial or ethnic makeup of your neighborhood. For decades, this practice systematically locked Black, immigrant, and other minority families out of the single greatest wealth-building tool in American history: owning a home. It created a cycle of disinvestment and poverty that we are still grappling with today. It was a stain on the nation's conscience. And in 1968, just 1 week after the assassination of Dr. Martin Luther King Jr., Congress passed the Fair Housing Act. It was a declaration signed into law that said, where you can live should be determined by the size of your wallet, not the color of your skin. It made it illegal to refuse to sell, rent to, or negotiate with any person because of their race or color. But it didn't stop there. Over the years, it's been expanded. The law now protects you from discrimination based on 7 specific categories, what the law calls protected classes. Think of them as 7 shields. First, race and color. Second, religion. A lender cannot ask you what church, synagogue, or mosque you attend. Third, national origin. Your ancestry, the country your parents or grandparents came from, is irrelevant. Fourth, sex. This includes gender identity and sexual orientation, thanks to subsequent court rulings. Fifth, disability. A lender can't deny you a loan because you have a physical or mental impairment. In fact, they have to make reasonable accommodations for you. And the last 2 are ones people often forget. Sixth, familial status. This is a huge one. It means a landlord or seller can't refuse you because you have kids, or because you're pregnant. And it means a mortgage lender can't look at a young couple and deny them a loan on the assumption that they might have kids soon, and that a new baby might impact their ability to pay. But there was a loophole. The Fair Housing Act was about the property itself, the sale, the rental, the advertising of the house. What about the money? What about the loan application process? In the early 1970s, it was still common practice for a bank to refuse to grant a mortgage to a woman without a male cosigner. It didn't matter if she was a doctor, a lawyer, or a business owner with a stellar income. Her finances were seen as secondary to a husband's. A divorced or widowed woman, she had an even harder time. The credit system was built by men for men. So, in 1974, Congress acted again, passing the Equal Credit Opportunity Act, or ECOA. If the Fair Housing Act protects the house, ECOA protects the credit application. It takes the shield of fairness and extends it directly into the lender's office. It says that anyone who applies for credit must be considered on the same terms. ECOA includes many of the same protections as the Fair Housing Act: race, color, religion, national origin, and sex, but it adds 3 more critical shields. First, marital status. A lender cannot ask if you're single, married, divorced, or widowed. They can only ask you to choose from married, unmarried, or separated, and only to determine your property rights in your state. They cannot treat you differently based on your answer. Second, age. They can't deny you a 30-year mortgage just because you're 65 years old, assuming your finances and life expectancy show you can repay the loan. As long as you are old enough to legally sign a contract, your age cannot be a negative factor. And third, and this is incredibly important, ECOA protects you if you receive public assistance income. A lender cannot look down on income from Social Security, disability, or a public housing program. If it's legal, stable, and documented income, it has to be considered just like income from a 9-to-5 job. So what does all of this mean for you as you get ready to apply for a loan? It boils down to the first and most important thing every single homebuyer needs to know. You have the right to be judged on your financial merits and nothing else. Your credit score, your income, your debt, your savings, that is the battlefield. Your race, your religion, your gender, whether you have kids, whether you're 35 or 75, that is all off limits. These laws force the lender to wear blinders, to see you only as a set of numbers on a spreadsheet. This brings us to the second thing every homebuyer needs to know, which is the practical application of that right. There are specific questions a lender is legally forbidden to ask you. Knowing what they are is like having a superpower. It allows you to spot a red flag from a mile away. A loan officer cannot ask you about your plans for having children. They can't say, "This is a great 2-bedroom, but are you planning on growing your family soon?" That's a violation of familial status. They are trying to gauge if your income might drop if one parent stays home, and that is illegal. They cannot ask about your spouse unless your spouse is a co-applicant on the loan, or you are relying on their income or alimony to qualify. If you are applying on your own merit, your spouse is a ghost. They don't exist to the lender. They cannot ask if you are widowed or divorced. They can't ask about your birth control practices. They can't ask what your religion is or what holidays you celebrate. They can't make comments, even seemingly positive ones like, "Oh, you're from Ireland? The Irish are such hard workers." That still singles you out based on national origin and could be used to build a discrimination case if you're later denied. Now, to be clear, they can ask some questions that seem personal, but are legally required for compliance. On the standard mortgage application, there's a section on your race, ethnicity, and sex. But this section is for government monitoring purposes only. It's used to help federal regulators track lending patterns and fight discrimination on a macro level. You are not required to answer these questions. You can select "I do not wish to furnish this information," and your choice cannot affect the loan decision in any way. They can also ask your age, but only to verify you're old enough to enter a contract, and to ensure that models they use to judge creditworthiness are not discriminatory. They can ask about your immigration status to determine your legal residency and ability to hold property in the U.S. These are legitimate financial inquiries, but the forbidden questions about family, about personal relationships, about your private life, those are the tripwires. If a lender asks you any of them, it's a sign that you might be dealing with someone who is either poorly trained or worse, is actively breaking the law. These 2 laws, the Fair Housing Act and the Equal Credit Opportunity Act, fundamentally shift the balance of power. You are not just a supplicant begging a bank for money. You are a consumer, armed with powerful federal rights. You have the right to a level playing field, where the only thing that matters is your ability to pay back the loan. But knowing your rights is only half the battle. The other half is understanding the lender's obligations. They can't just operate in a black box and spit out a yes or no. They have to show their work. They are required by law to give you documents so clear, so detailed, that they leave no room for bias to hide. And the very first one of these critical documents you will ever see is called the loan estimate. It's a simple 3-page piece of paper that holds the entire key to the financial reality of your mortgage. And understanding how to read it is the next crucial step on your journey to owning a home. So let's open it up. Imagine this document is a treasure map. Some parts lead to gold and some parts lead to traps. And right now, we're going to learn how to tell the difference. Before 2015, lenders gave you something called a good faith estimate, which was frankly a mess. It was confusing, non-standardized, and some lenders used that confusion to hide junk fees and surprise you at the closing table with higher costs than you were promised. It was a bait-and-switch nightmare. The government stepped in and created the loan estimate to fix this. Its entire purpose is to empower you, the buyer. It forces every single lender in the United States to present their offer in the exact same format, so you can compare them apples to apples, with no tricks and no place to hide. The first thing you will see top of page 1 is the most basic information: the date, your name, the property address, and the sale price. But right below that is the first critical checkpoint, the loan terms section. This is the heart of the deal. Of course, you'll see the loan amount, but look closer. You'll see the interest rate. Is it the rate you were promised? But here's the first trap many people fall into. They see the rate and they stop reading. Right next to that rate is a tiny little question. Can this amount increase after closing? If that box says yes, you are not looking at a fixed rate mortgage. You are looking at an adjustable rate mortgage, or an ARM. This means your interest rate, and therefore your monthly payment, can and will change in the future. Now, ARMs aren't inherently evil. They can be a useful tool for some people in some situations. But you need to know with 100% certainty which type of loan you are signing up for. Surprises here can be financially devastating down the road. And just below that, you'll find arguably the most important checkbox on the entire form. Is this rate locked? With a yes or a no next to it. An unlocked rate is just a quote. It's an idea. It's what the rate is today. It is not a promise. Interest rates can change daily, even hourly. If your rate is not locked, it can go up between now and when you close on the house, potentially costing you tens of thousands of dollars over the life of the loan. The form will even tell you when the rate lock expires. This date is your deadline. You need to close by then or that lock is gone. So, checkpoint 1, confirm the loan type is what you want and confirm your rate is locked. Next, let's talk about the money. This is what it all comes down to, right? How much is this going to cost me? The loan estimate breaks this down into 2 categories: the money you pay every month and the money you pay one time up front. On page 1, you'll see a section called Projected Payments. This is your estimated monthly mortgage payment. But this isn't just one number. It's made of 4 key ingredients, a recipe known as PITI: principal, interest, taxes, and insurance. Principal is the part of your payment that actually pays down your loan balance. Interest is the fee you're paying the bank for the privilege of borrowing their money. In the early years of your loan, most of your payment is just interest. It's a sobering reality. But the last 2 letters, T and I, are where people get into trouble: taxes and insurance. The lender is estimating what your annual property taxes and homeowner's insurance will be. They divide that by 12 and add it to your monthly payment. This money doesn't go to the bank. It goes into a special savings account called an escrow account, and the lender pays your tax and insurance bills for you once a year. Here's the secret. The lender's estimate for these costs can be wrong. They might underestimate your property taxes, making your initial monthly payment look artificially low. But a year later, when the actual tax bill comes in, your payment could jump up by hundreds of dollars a month to cover the shortfall. This is called an escrow shortage, and it's a nasty surprise. So do your own homework. Call the county tax assessor's office and get an accurate estimate for a home of that value. Shop for homeowner's insurance yourself to know the real cost. Don't blindly trust the lender's T and I estimate. Now for the second part of the money equation, the big chunk of cash you need to bring to the closing table. Flip to page 2. This page is titled Closing Cost Details, and it can be terrifying. You'll see a big number at the bottom called Estimated Closing Costs. This includes lender fees, title fees, appraisal fees, and a whole host of other charges. It can feel overwhelming, but this page contains a secret weapon. The costs are broken down into sections. Look for one called Services you can shop for. This is gold. The government is literally telling you, hey, you don't have to use the companies the lender recommended for these services. You can find someone cheaper. This applies to things like the title search, the pest inspection, and the survey fee. By spending a few hours calling around to different providers for these services, you can often save yourself $1,000 or more. The lender is legally required to accept your choice, as long as the provider is licensed and reputable. They are counting on you being too busy or too intimidated to shop around. Don't be. Finally, let's go to page 3. If page 1 is the snapshot of the deal and page 2 is the upfront cost, page 3 is the time machine. It shows you the long-term consequences of your decision. There's a section called Comparisons. It tells you, in plain English, how much you will have paid in total over the first 5 years of the loan, and critically, how much of that money actually went to paying down your principal. For most people, this number is a shock. You might make $60,000 in payments over 5 years, only to find you've paid off less than $15,000 of your actual loan. It's a stark reminder of how interest works. And right next to that, you'll find the APR, the annual percentage rate. People always get this confused with the interest rate. They are not the same. The interest rate is simply the cost of borrowing the money. The APR is the true cost of the loan. It takes the interest rate and then rolls in all the lender fees, mortgage insurance, and other charges, and expresses it as a percentage. Think of it this way. The interest rate is the sticker price of the car. The APR is the out-the-door price after all the taxes, title, and dealer fees are added in. When you are comparing offers from two different lenders, the APR is the most accurate way to see which loan is actually cheaper. A lender might offer a slightly lower interest rate, but then load up the loan with fees, giving it a higher APR. Always compare the APR. This 3-page document is your shield and your sword. It protects you from bad deals and allows you to fight for a better one. Its entire power lies in comparison. You should never ever just get one loan estimate from one lender. Your goal is to get at least 3. Lay them out side by side. Compare the interest rates. Compare the APRs. Compare the fees in the services you can't shop for section. Challenge the lenders. Ask them, why is your origination fee higher than this other offer? You'd be amazed how often those fees can magically shrink when a lender knows you're an educated consumer who is shopping around. Understanding this document transforms you from a hopeful applicant into a commanding negotiator. You now know the terms, you know the costs, and you know the long-term reality. You've decoded the offer. But now that you have a deal you like, you have to officially win the bank's approval. And that means you're about to enter the single most invasive and stressful part of the entire home buying process. It's a deep, probing financial background check known as underwriting, and you need to be prepared for what they're about to ask for and what they're about to find. So let's pull back the curtain on this mysterious figure known as the underwriter. Who is this person? Think of them not as a loan officer trying to sell you something, but as a financial detective, a risk assessor whose only job is to protect the lender's money. They don't know you. They don't care about your dream of a white picket fence or a backyard for your dog. Their entire career is based on one question. If we give this person hundreds of thousands of dollars, what are the mathematical odds we will get it back with interest? To answer that question, they conduct a deep forensic audit of your financial life. It's not personal, it's purely statistical. They are looking for patterns, red flags, and, above all, stability. They do this by examining what the industry calls the 3 C's of credit: capacity, credit, and collateral. Master these 3 concepts and you'll not only survive underwriting, you'll understand the entire logic behind mortgage lending. Let's start with the first and most important C, capacity. This is your ability to repay the loan. It sounds simple, right? You have a job, you make money. But an underwriter goes so much deeper. They're looking at the raw, undeniable math of your cash flow, and the key metric they use is your debt-to-income ratio, or DTI. Imagine your total gross monthly income. That's your salary before taxes, health insurance, anything is taken out. Imagine that number is a big, fresh pie. Now, every single monthly debt payment you have is a slice of that pie that's already promised to someone else. Your car payment? That's a slice. Your student loan payments? Another slice. The minimum payments on all your credit cards, even if you pay them off every month? Slices. Child support, personal loans, all slices. The underwriter adds up all those slices, then adds the proposed new mortgage payment. That's principal, interest, taxes, and insurance, and they see how much of your pie is left. Generally, lenders want to see that your total debt, including your new house payment, doesn't eat up more than 43% of your pie. Some loan programs might go a little higher to 45% or even 50%, but that's pushing the absolute limit. If your DTI is too high, the lender's algorithm screams, high risk. You have no wiggle room. One unexpected car repair, one medical bill, and you could be in danger of missing a mortgage payment. This is why they scrutinize your income so intensely. If you're a W-2 employee who's been at the same job for over 2 years with a steady salary, that's a green flag. It's predictable. But what if you just change jobs? They'll want to see your offer letter and your first pay stub to verify the new income. What if you get paid a lot in bonuses or commissions? They won't just take your word for it. They'll need 2 years of tax returns to see the history. They'll average it out to make sure it's consistent, not a one-time fluke. And if you're self-employed, get ready. This is where the scrutiny goes to another level. You are your own boss, which to an underwriter means your income is inherently less stable. They will demand at least 2 years of full business and personal tax returns. They will analyze your profit and loss statements. They will look at your business bank accounts. They are trying to establish a predictable, reliable monthly income from a business that, by its nature, can be unpredictable. This is one of the biggest hurdles for entrepreneurs trying to buy a home. Your capacity isn't just about making money. It's about proving you've made it consistently over time and are likely to continue making it. The second C is credit. This is your documented history of repaying debt. Your credit score is the headline, but the underwriter reads the entire article. They will pull a comprehensive tri-merge credit report from all three bureaus, Equifax, Experian, and TransUnion, and go through it line by line. They're looking at your story. Have you had late payments? A 30-day late payment on a credit card from 3 years ago isn't a deal killer, but it's part of a pattern. A 90-day late payment on a car loan last year? That's a major red flag. It shows a recent, significant problem managing debt. Have you had accounts go to collections? A medical collection from 5 years ago might be overlooked, but an unpaid cell phone bill from last year shows a current disregard for financial obligations. They look at your credit utilization, how much of your available credit you're using. If all your cards are maxed out, it suggests you're living on the financial edge, relying on debt to get by. They look at the length of your credit history. A long history with a mix of different types of credit like a car loan, student loans, and a few credit cards all paid on time shows you have experience and discipline. And this is where we have to issue a critical warning. From the moment you apply for a mortgage until the day you close, consider your credit frozen. Do not open any new lines of credit. Do not finance a new car to go in the new garage. Do not buy new furniture for the new living room on a store credit card. Do not co-sign a loan for anyone. Any new debt or even a new credit inquiry can change your DTI and your credit score at the last minute, forcing the underwriter to reevaluate everything. Horror stories abound of buyers who were denied a mortgage the day before closing because they bought a new refrigerator on credit. Don't let that be you. The third C is collateral. This is the house itself. You could have a perfect 850 credit score and a 7-figure income, but if the house you're buying isn't worth the price you're paying, the deal is dead. Remember, the house isn't just your home. It's the bank's insurance policy. If you stop making payments, they foreclose and sell the house to get their money back. So they need to be absolutely certain the house is worth at least as much as they're lending you. This is where the appraisal comes in. The lender will hire an independent, third-party appraiser to determine the fair market value of the property. This appraiser will visit the home, measure it, note its features and condition, and compare it to similar, recently sold properties in the same neighborhood, what are known as comps. If the appraisal comes in at or above the purchase price, everyone breathes a sigh of relief. Green light. But if it comes in low, you have a problem. Let's say you agreed to buy a house for $400,000, but the appraiser says it's only worth $380,000. The bank will only lend you money based on the lower value, the $380,000. This creates a $20,000 gap. You now have three options. You can try to negotiate with the seller to lower the price to the appraised value. You can come up with the extra $20,000 in cash yourself, or you can walk away from the deal assuming you have an appraisal contingency in your contract. The underwriter will not approve a loan where the collateral isn't sufficient to cover the risk. Capacity, credit, collateral. Those are the pillars. But the underwriter's job doesn't stop there. They also have to verify the source of every single dollar you're using for your down payment and closing costs. This is where things can feel truly invasive. They will ask for your last 2 to 3 months of bank statements for every account you have, checking, savings, investment accounts. And they will scrutinize every single deposit. Your regular paycheck? Fine. A transfer from your savings? Fine. A $50 check from your aunt for your birthday? Fine. A random, undocumented cash deposit for $10,000? That is a 5-alarm fire for an underwriter. Where did that money come from? Was it a loan from a friend that you'll have to pay back, which would increase your DTI? Was it a cash gift from a relative? If so, you'll need a signed gift letter from that person stating the money is a true gift with no expectation of repayment, and you'll often need to show the money coming out of their bank account and into yours. This isn't just the bank being nosy. Federal laws like the Bank Secrecy Act and the Patriot Act require them to verify the source of large sums of money to prevent money laundering. That cash you've been stashing under your mattress for years? It's almost impossible to use for a home purchase. You have to season the funds, meaning they have to be sitting in your bank account for several months before you even apply, so they appear on statements the underwriter isn't looking at. After weeks of this intense scrutiny, of sending pay stubs, tax returns, and letters of explanation for every tiny financial quirk, you will finally get a decision. But it's rarely a simple approved. Instead, you're likely to receive something far more daunting: a conditional approval. You've passed the first major test. The underwriter believes you can repay this loan if you meet a list of their final demands. And that list can be the final exhausting sprint before you reach the finish line. This list of conditions can feel like a personal attack. After you've handed over every financial document you've ever touched, after you've bared your soul on an application, a faceless underwriter sends back a list of demands. It's invasive. It's exhausting. And your first thought is probably, why? Don't they trust me? Here's the critical truth you have to understand. It has almost nothing to do with trust. It has everything to do with risk and regulation. Every single condition on that list is a direct consequence of the laws designed to prevent another 2008 financial crisis. The underwriter isn't just protecting the bank's money. They are legally required to build an ironclad, auditable file that proves to federal regulators they followed the law. Specifically, the ability to repay rule. This rule mandates that lenders make a reasonable, good faith determination that you have the ability to repay your loan. Their good faith determination is that list of conditions. They are essentially reverse engineering your financial life to create a legal shield. Your frustration is a byproduct of their compliance. So let's pull back the curtain on the most common, most maddening conditions you're likely to face. The number one item that trips people up is the demand to source large deposits. Let's say you've been saving diligently. You open your bank statements, and the underwriter has circled a deposit from 2 months ago for $3,000. And another one for $5,000. Now they want to know in detail where that money came from. Feels absurd. It's your money. But to an underwriter, an undocumented, large cash deposit is a massive red flag. Why? Because federal anti-money laundering laws, like the Bank Secrecy Act, require them to flag and investigate any suspicious activity. A large, unexplained cash deposit looks exactly like the kind of thing they are legally obligated to question. They need to prove to the government that this money isn't from an illicit source or, just as importantly, that it isn't an undisclosed loan from a friend or family member. An undisclosed loan would be a debt that doesn't show up on your credit report, and it would throw off your entire debt-to-income ratio, which is a cornerstone of that ability to repay rule. So how do you handle it? You need a paper trail for everything. That $3,000 deposit? That was from selling your old car on Craigslist. You need to provide a copy of the bill of sale, a copy of the check you deposited, and maybe even a copy of the cash check from the buyer's bank. That $5,000 deposit? That was a generous gift from your parents to help with the down payment. This is incredibly common, but you can't just say, "My mom gave it to me." You need to execute a formal gift letter. This is a legal document, a sworn statement, where your parents declare the specific amount of money given, the date it was transferred, and explicitly state that the money is a true gift with no expectation of repayment. They will have to sign it, and you will have to provide a bank statement showing the money leaving their account and another showing it arriving in yours. Every link in the chain must be documented. It's not about trust. It's about creating a federally compliant, unbroken paper trail. The second condition that derails countless deals happens in the final 72 hours before closing. It's the final verification of employment, or VOE. You've been cleared. You've packed your boxes. You're dreaming about paint colors. Then your loan officer calls with a panicked voice. The underwriter did their final check and you no longer work at your job. Deal's dead. This is not a hypothetical. It happens all the time. People think, "I'm approved. I can finally quit this job I hate and start my own business." Or my company offered me a promotion, but it's a new role with a different pay structure. From the moment you apply for that loan until the moment the keys are physically in your hand, you are in a financial lockdown. Do not change jobs. Do not quit your job. Do not go from a salaried W-2 employee to a 1099 independent contractor. Do not deposit large, unusual amounts of cash. Do not co-sign for your cousin's car loan. And for the love of all that is holy, do not buy new furniture for the house on a new credit card. The underwriter approves a specific financial snapshot in time. The law requires them to re-verify that snapshot right before they wire hundreds of thousands of dollars. If your picture has changed, if your income, your debt, or your employment status has changed, they can and they will pull the plug even on the morning of your closing. Next up is the dreaded letter of explanation, or LOX. Maybe you had a late payment on a student loan 2 years ago. Maybe there's a credit inquiry from a store you don't even remember visiting. Or maybe there was a 6-month gap in your employment history. The underwriter will demand a written explanation. This isn't the time to write a novel about your life struggles. This is a legal document for the file. Your lock should be concise, factual, and professional. State the issue clearly. Regarding the late payment to Fed loan in May 2021, explain what happened briefly and take responsibility. At the time, I was experiencing a medical issue that caused me to overlook the payment. This was an isolated incident. Finally, state how it was resolved and that it won't happen again. The account was brought current the following month and has been on autopay with a perfect history ever since. I have implemented a system of financial checks to ensure all my obligations are met on time. That's it. Short, simple, and it gives the underwriter exactly what they need to check the box and move on. You'll also see conditions related to the property itself. The appraisal is a big one. The home must appraise for at least the purchase price. If it comes in low, the bank will not lend you more than the home's determined value. This is a legal and financial backstop for them. If you default, they need to be able to sell the house and recoup their investment. If the appraisal is low, a whole new negotiation begins with the seller. Another property-related condition is a clear title. A title company will do a deep dive into the property's history, looking for any old liens, ownership disputes, or unresolved claims. What's called a cloud on title. For example, maybe a contractor put a lien on the house 10 years ago because the previous owner never paid for a new roof. That lien must be legally satisfied and removed before the bank will fund the loan. Because federal lending laws require the bank's mortgage to be the primary, senior lien on the property. Seeing this list of conditions is overwhelming. It's the final boss battle of the mortgage process. But I want you to reframe how you see it. That list is not a sign of weakness. It's the opposite. It is the final checklist before you are given the keys to your future. Each document you provide, each letter you write, each paper trail you create is another lock turning. You are not being interrogated. You are actively building the legal case for your own homeownership. The underwriter isn't your adversary. They are the final gatekeeper, and your job is to give them every single key they ask for. And when you provide that last document, that final obscure pay stub or that perfectly worded gift letter, you will get 3 of the most beautiful words in the English language emailed to you from your loan officer, clear to close. And that's when everything changes. This is it. The summit. The moment you've been fighting for. That email is your signal that the underwriter, that faceless, all-powerful gatekeeper, has stamped their final unconditional approval on your loan. You've conquered the mountain of paperwork. You've won. But here's the thing about conquering a mountain: you still have to get down the other side. And that descent is just as treacherous, just as important as the climb. Because between clear to close and holding the keys to your new home lies the single most important legal event of the entire process: the closing. And it all starts with a document that is, by law, designed to protect you. Within hours of getting that clear to close, you're going to receive another critical document. It's called the closing disclosure, or the CD. I want you to think of this document as the final exam for your mortgage. But here's the beautiful part. The federal government forces the lender to give you all the answers, in writing, 3 full business days before you ever have to take the test. This isn't just a courtesy. It's the law. It's a cornerstone of what's known as the TILA-RESPA Integrated Disclosure Rule, or TRID. It's a mouthful, I know, but its nickname is much simpler. The know before you a rule. And that's its entire purpose, to make sure you know, down to the penny, exactly what you owe and what you're agreeing to, long before you're sitting at a table with a notary staring you down. This 5-page document is the culmination of everything. It finalizes all the numbers that, up until now, have been estimates. Your loan estimate was the blueprint. The closing disclosure is the finished building. Your job, your legal right and responsibility during this 3-day window, is to be the world's toughest building inspector. You need to go through this document with a fine-tooth comb and compare it, line by line, to that initial loan estimate you received weeks ago. Let's break down what you're looking for. Page 1 is the big picture. At the very top, you'll see the loan terms. Is that the interest rate you were promised? Is it a 30-year fixed loan like you thought? Or did something change? Is the loan amount exactly what you expected? If your rate is 5.75% and the paper says 5.875%, that's not a typo. That's a red flag. You stop everything and you call your loan officer immediately. Next, you'll see your projected payments. This is your pity. principal, interest, taxes, and insurance. Does this monthly payment number look familiar? Does it align with what you've been planning for? Lenders will often use estimates for property taxes and homeowners insurance, so this is the first time you'll see the actual numbers plugged in. Sometimes this can cause a little sticker shock, but it's far better to have that shock now than after you've already signed on the dotted line. Now flip to page 2. This is the nitty-gritty. This is the detailed breakdown of all your closing costs. You'll see Section A, the origination charges. This is what your lender is charging you to make the loan. By law, this fee cannot increase from your loan estimate without a valid changed circumstance, which is a very narrow set of specific situations. If that number is higher, you have a legal right to question it and, in most cases, demand they honor the original estimate. Then you'll see a long list of other fees: the appraisal fee, the credit report fee, title insurance fees, recording fees for the county. Your job is to scan this list for 2 things. First, are there any fees you don't recognize? Any junk fees that seem out of place? Second, how do these totals compare to your loan estimate? The law breaks these costs into categories. Some, like the lender's origination fee, can't change at all. Others, like title services and appraisal, have a 10% tolerance, meaning they can't increase by more than 10% in total from the estimate. And some, like your prepaid homeowner's insurance, can change because you're the one who shopped for it. Understanding these tolerances is your power. It's how you hold your lender accountable. Finally, at the bottom of page 3, you'll find the magic number: the cash to close. This is it. This is the exact dollar amount you need to bring to the closing table. It's your down payment plus all those closing costs, minus any earnest money deposit you've already paid. This number should be crystal clear. There should be no surprises here. This 3-day review period is your legally mandated cooling-off period. The law was written specifically to kill the old, high-pressure tactic of shoving a 100-page stack of documents in front of a buyer at the closing table and saying, "Sign here, here, and here." The government is forcing you to take a breath, to sit with these numbers, to ask questions, and to be 100% confident before you make the single biggest financial commitment of your life. And this rule has teeth. If certain key things change after you receive this disclosure, specifically if the APR on your loan increases by more than 0.1%, if a prepayment penalty is added, or if the basic loan product itself changes, like from a fixed rate to an adjustable rate, the lender is legally required to issue a new closing disclosure, and the 3-day clock starts all over again. They can't rush you. The law is on your side. So what do you do during these 3 days? First, you review. You call your loan officer and your real estate agent and go over every single line. Ask dumb questions. There are no dumb questions when hundreds of thousands of dollars are on the line. But your second task is just as critical. You need to arrange for your funds. That final cash to close number needs to be wired to the title company or closing attorney. And this brings us to one of the most dangerous and heartbreaking scams in all of real estate: wire fraud. I need you to listen to me very carefully. This is not a drill. Criminals are actively targeting real estate transactions. They hack into the email accounts of real estate agents, loan officers, or title companies. They will watch the transaction progress, and at the last minute, they will send you an email that looks perfectly legitimate. It will have the title company's logo, the correct property address, and your name. It will contain new, updated wiring instructions, often with a plausible-sounding excuse like, "Our main account is under audit. Please use this other account for today." If you follow those instructions, your money, your entire life savings, will be sent to a hacker's offshore account, and it will be gone forever. There is no FDIC insurance for this. There is no getting it back. It is a life-altering catastrophe. So here is the one unbreakable rule of wiring your closing funds. You must, under absolutely no circumstances, ever wire money based on instructions you received in an email. Period. You get the wiring instructions from the title company, either in person or from an initial secure communication. Then you pick up the phone. You find the title company's phone number from a trusted source, like your agent or the original contract, not from the email itself. You call the number and you speak to a human being you know. You verbally confirm the name of the bank, the routing number, and the account number. You read it to them and they read it back to you. Only then, after you have verbally confirmed every single digit, do you go to your bank and authorize the wire. Do not let anyone, not a seemingly urgent email, not a text message, not a phone call out of the blue, convince you to change those instructions at the last minute. Your financial security depends on it. With the wire sent and confirmed, There's one last thing to do before you sit down at that table. The final walkthrough. This usually happens the day of or the day before closing. This isn't a home inspection. That's long over. This is you walking through the now empty house to verify that it's in the same condition it was when you agreed to buy it, and that any contractually obligated repairs have been completed. Does the AC still work? Are the appliances that were supposed to stay still there? Did the sellers punch a hole in the wall when they moved their couch out? If something is wrong, you don't close. You call your agent and they negotiate a solution right then and there, a credit at closing, a holdback of funds in escrow. You have all the leverage in this moment because everyone wants the deal to close. And once that's done, there's nothing left to do. You've climbed the mountain of underwriting. You've navigated the treacherous descent of the closing disclosure. You've dodged the wire fraud bandits. Now all that's left is to walk into a quiet, sterile conference room, where a very nice person is sitting behind a stack of paper that feels a mile high. Your pen is in your hand. The keys are just on the other side of that stack. And you're about to start signing your name over and over and over again. But this isn't just a formality. This is the moment of truth. This stack of paper is a legally binding contract that will likely be the single largest financial commitment of your entire life. And what you're about to sign is governed by some of the most important consumer protection laws in the country. Laws that were written in the ashes of a global financial crisis specifically to protect you right here in this moment. This brings us to the fourth thing every homebuyer absolutely needs to know: understanding your closing documents and the superpower the law gives you to control the process. Let's talk about that stack of paper. It's filled with disclosures, affidavits, and acknowledgments. But reigning over them all is one king document. It's called the closing disclosure, or the CD. Think of the CD as the final, itemized receipt for your house. It's the document that officially lays out, down to the penny, exactly what your mortgage is, what it costs, and how much money you need to bring to the table to get those keys. It is, without a doubt, the most important piece of paper you will sign besides the mortgage note itself. Now, why is this so critical? To understand that, we have to take a quick trip back in time to the days before the 2008 housing crisis. In that era, it was terrifyingly common for a homebuyer to get a quote for a loan, agree to the terms, and then show up at the closing table only to find that the numbers had changed. Suddenly, the interest rate was a little higher. The closing costs had mysteriously ballooned with new unexplained fees. The cash you needed to close was thousands of dollars more than you were told. Imagine the pressure. You've already packed your boxes. You've given notice to your landlord. The moving truck is booked. The sellers have their own truck packed. You're sitting in that sterile conference room, and the lender essentially has you over a barrel. You feel like you have no choice but to sign, to just swallow the extra costs and deal with the consequences later. This high-pressure, last-minute bait-and-switch was a huge contributing factor to the subprime mortgage meltdown. It trapped people in loans they couldn't afford from the very first day. After the crash, the government stepped in and said, "Never again." They created what is colloquially known as the Know Before You Owe rule. The official name is the TILA-RESPA Integrated Disclosure Rule, or TRID, but all you need to remember is, know before you owe. This law fundamentally changed the balance of power at the closing table, and it did it with one simple, brilliant requirement. The law mandates that your lender must provide you with your final closing disclosure at least 3 full business days before your scheduled closing. Let me say that again because it is your single greatest protection in this entire process. They have to give you the final numbers a full 3 business days before you are allowed to sign. This isn't a suggestion. It's not a courtesy. It is a federal law, and there are massive penalties for lenders who violate it. This 3-day review period is your superpower. It completely eliminates that high-pressure last-minute surprise. The days of the closing table ambush are over. This period gives you the time and the space, away from the pressure of the closing agent and the sellers, to sit down at your kitchen table with a cup of coffee and calmly review every single number. It gives you time to compare it to the last loan estimate you received. It gives you time to call your loan officer, your real estate agent, or even an attorney and ask questions. What is this fee? Why did this charge go up? I don't understand this calculation. If there are mistakes, and mistakes do happen, it gives everyone time to fix them before you're on the hook. So, what should you be looking for on that 5-page document? Don't be intimidated. You just need to focus on the big stuff. First, look at page 1. This is the summary. It clearly shows the loan amount, your interest rate, your monthly principal and interest payment, and whether there's a prepayment penalty or a balloon payment, which for most standard loans there shouldn't be. Then it has a costs at closing section which shows your total closing costs and the total cash to close. This page is your gut check. Do these numbers look like what you were promised? Is the interest rate correct? Is the monthly payment what you expected? If anything on page 1 looks wrong, you need to stop and ask why. Next, flip to page 2. This is the detailed breakdown of all those closing costs. It's split into 2 main columns: loan costs and other costs. This is where you can see exactly where every dollar is going. You'll see the lender's origination fees, the appraisal fee, the title insurance costs, the recording fees for the county. Pay close attention here. Compare these figures to your loan estimate. By law, some of these fees have a zero tolerance for change, meaning they cannot increase at all from your loan estimate. Others have a 10% tolerance and some can change freely. If you see a brand new processing fee or underwriting fee that was never disclosed before, you have the right to challenge it. Then the most important part, page 3. At the top, there's a table called Calculating Cash to Close. This is the final math. It shows the total amount of money you need to bring to closing. It starts with the price of the home, adds in your closing costs, and then subtracts things like your earnest money deposit, any credits the seller is giving you, and your total loan amount. The final number at the bottom of this table is what you will need to wire or bring as a cashier's check. Thanks to the 3-day rule, this number should never ever be a surprise. This simple 3-day window, shifted the entire dynamic. It forces lenders to be accurate and transparent upfront, because they know you have 3 days to scrutinize their work. It empowers you, the consumer, to be the final quality check on the biggest transaction of your life. But what if you go through all that, you sign the papers, the keys are in your hand, and then you wake up in a cold sweat the next day filled with regret? Is there any way out? This brings us to a related and often misunderstood legal concept: the right of rescission. This is the 5th and final major legal concept every homebuyer should know. The right of rescission is a federal law under the Truth in Lending Act that gives you a 3-day cooling-off period to cancel certain types of mortgage contracts without penalty. You can literally change your mind, send a letter, and the deal is unwound as if it never happened. Sounds amazing, right? A get-out-of-jail-free card. But here is the critical multi-million-dollar piece of information that so many people get wrong. The right of rescission does not apply to mortgages used to purchase a home. Let me repeat that because it's vital. You cannot use the right of rescission to back out of a deal after you've closed on a new house. And it makes sense if you think about it. Imagine the chaos if buyers could just change their minds after the sellers have already moved out and bought their own new home. The entire chain of real estate transactions would collapse. So when does it apply? The right of rescission applies almost exclusively when you are refinancing the mortgage on your primary residence. If you already own your home and are just getting a new loan to replace the old one, maybe to get a lower interest rate or take cash out, the law gives you that 3-day window after signing to cancel the deal. It also applies to home equity lines of credit, or HELOCs. But for the purchase of a new home, a vacation home, or an investment property, no. Once you sign those closing documents and the money changes hands, that home is yours. There is no 3-day take-back. So as you sit there with that pen in your hand, that stack of papers no longer looks like an intimidating monster. Just a confirmation. It's the final chapter of a story you've been reading for the past 3 days. You've checked the numbers. You've asked the questions. You understand the terms. You're not being rushed. You're not being tricked. You are in control. You are making an informed, deliberate decision. You pick up the pen, take a deep breath, and confidently sign your name, knowing exactly what you're agreeing to. The deal is done. The keys slide across the table into your waiting hand. They're heavier than you imagined. You are officially a homeowner. But your legal journey with this mortgage isn't over. In fact, it's just beginning. Because now you have to actually live with this loan for the next 30 years. And what happens next month, when that first bill arrives from a company you've never even heard of? This is not a scam. This is the 4th major thing every homebuyer needs to know. Your loan is a product, and it will almost certainly be sold. And the law that governs this entire confusing process is your best friend. You see, in the modern mortgage world, the company that gives you the money, the one you spent months building a relationship with, the one whose name is on all your closing documents, is often not the company that will manage your loan for the next 30 years. There's a difference between a lender and a mortgage servicer. Think of it like this. A chef might create a world-class recipe and cook the meal, but it's the waiter who brings it to your table, refills your water, and handles the bill. The lender is the chef who created your loan, The servicer is the waiter who manages the day-to-day business of collecting your payments. And just like a restaurant can have many different waiters, the rights to service your loan can be bought and sold between different companies, often without you having any say in the matter. Your original lender might sell the servicing rights because they're not equipped to handle millions of monthly payments. Or they might sell it simply to free up capital so they can go make more loans. To them, it's just a business transaction. To you, it feels like a betrayal. Suddenly, you're forced into a relationship with a new company you've never heard of, in a state you've never been to, and you're expected to just start sending them thousands of dollars every month. This is where so many new homeowners get into trouble. They see a letter from ACME Mortgage Servicing and toss it in the junk mail pile, thinking it's a solicitation. Then they keep paying their original lender, who cashes the check but doesn't apply it to the loan anymore because they don't own it. A month later, ACME Servicing reports a missed payment to the credit bureaus. Your perfect credit score takes a nosedive, all because nobody explained the rules of the game. But you are not powerless. The federal government knows this process is confusing and ripe for abuse. That's why they created specific protections under a powerful law called the Real Estate Settlement Procedures Act, or RESPA. Under RESPA, when your loan servicing is transferred, you are legally entitled to 2 separate notices. Your old servicer must send you a goodbye letter at least 15 days before the transfer is effective. And your new servicer must send you a hello letter within 15 days after the transfer is effective. Often, they'll just send a single combined letter. This letter is one of the most important pieces of mail you will ever receive as a homeowner. It will explicitly state the date the old servicer will stop accepting payments and the date the new servicer will start. It will give you the new company's name, address, and customer service number. Do not throw this letter away. But the law provides an even bigger safety net. RESPA gives you a 60-day grace period from the date of the transfer. During these 60 days, if you get confused and accidentally send your mortgage payment to the old servicer instead of the new one, the new servicer is legally forbidden from charging you a late fee. The old servicer is required to forward the payment to the new servicer or return it to you, and your credit report is protected. This is a critical shield that gives you time to adjust, update your online bill pay, and make sure your money is going to the right place without being penalized for an honest mistake. So when that strange letter arrives, don't panic. Open it, read it, call the number for your old lender, the one you trust, and confirm the transfer is legitimate. Then, set up your payments with the new company. This is the new normal of your financial life. But this brings us to the 5th and final thing you need to know, because it's not just about who you pay. It's about what you're paying for. That single monthly payment you make isn't just for the loan itself. It's usually a combination of 4 things, known by the acronym PITI: principal, interest, taxes, and insurance. The principal and interest are what you owe the bank on the loan. That part is fairly stable. But the T and the I, your property taxes and your homeowner's insurance, are a completely different story. And they are managed through a special holding account controlled by your servicer, called an escrow account. Here's how it works. Every month you pay a little extra, say a few $100s on top of your principal and interest. That extra money doesn't go toward paying down your loan. Instead, your servicer puts it into your escrow account. Then when your big property tax bill or your annual homeowner's insurance premium is due, the servicer pays it for you on your behalf, using the funds from that account. In theory, it's a brilliant system. It forces you to save for these huge, predictable expenses so you're not hit with a $5,000 tax bill you can't pay. But in practice, it creates a massive point of friction and potential financial shock. Why? Because your property taxes and your insurance premiums are not fixed. They can and they will go up. Your local government might reassess your home's value and jack up your property taxes. Your insurance company might raise its rates after a season of bad weather in your region. But you don't see these increases directly. Your servicer does. They pay the higher bills out of your escrow account. And at least once a year, they are legally required to do something called an escrow analysis. They look at what they paid out for you last year, project what they think they'll have to pay next year, and compare it to how much you've been paying into the account each month. And this is when you get the second scary letter of homeownership. It's the escrow shortage notice. The letter will say something like, "Last year, your taxes and insurance were higher than we projected, so your escrow account is now $2,000 in the hole. Also, we project they'll be even higher next year. Therefore, your monthly mortgage payment is going up by $300, effective immediately." For millions of Americans on a tight budget, that letter is a catastrophe. Feels like a bait and switch. Your mortgage payment, which you thought was fixed, suddenly skyrockets and you have no idea why. People scream at their servicer, but the servicer just points the finger at the tax office and the insurance company. Once again, the law gives you rights. RESPA sets strict limits on how your escrow account can be managed. First, the servicer cannot keep an excessive amount of your money. They are only allowed to maintain a cushion equal to 2 months' worth of escrow payments. Anything more than that is considered an overage. If your annual analysis finds a surplus of $50 or more, the servicer must send you a refund check. Second, that annual escrow statement they send you has to be detailed. It must clearly show how much came in from your payments, how much went out for taxes and insurance, and how they calculated your new payment for the upcoming year. You have the right to understand their math. If you get a notice of a shortage and a payment increase, call them. Make them walk you through the numbers line by line. Ask for copies of the tax bills and insurance statements they paid. Verify everything. Sometimes they make mistakes. And if you believe your servicer is making a mistake, not communicating with you, or is violating these rules, you have a nuclear option. You can file a formal complaint with the Consumer Financial Protection Bureau, or CFPB. This is a federal agency that acts as the top watchdog for the mortgage industry. Filing a complaint with the CFPB forces the servicer to provide a formal, written response to you and the government, explaining their actions. It is the single most powerful tool. You have to hold your servicer accountable. So you've survived the closing, you've figured out who your servicer is, and you've learned to scrutinize your escrow account. You're managing the loan. But what about the end game? This 30-year legal document isn't a life sentence. People move, they upgrade, they sell. But what happens if you try to get out early? What hidden traps in the fine print can penalize you for paying off your own house? That trap has a name. It's called a prepayment penalty clause, and it's the fifth and final piece of the mortgage law puzzle every single homebuyer needs to understand. It's the legal fine print that says, "Congratulations on your financial success. Now pay us for the privilege of leaving." Picture this scenario. 5 years into your 30-year mortgage, you get the promotion of a lifetime. It comes with a massive life-altering bonus. Your first thought after you stop hyperventilating is to eliminate your biggest debt. You want to own your home free and clear. You call your lender, beaming with pride, ready to make that final payment and feel the weight of the world lift from your shoulders. The person on the other end of the line says, "That's wonderful news. We can certainly process that for you. The remaining principal balance is $250,000, and according to the prepayment penalty clause in your agreement, there will be an additional fee of $5,000. The phone feels heavier in your hand. A $5,000 fee for paying back the money you borrowed? Feels like a shakedown. Feels fundamentally unfair. And in that moment, you realize the contract you signed wasn't just a loan, it was a business deal, and the bank planned on making a very specific amount of profit from you over 30 years. Your early payment just threw a wrench in their financial forecast. So why on earth do these clauses exist? It comes down to the basic business model of lending. When a bank gives you a mortgage, they aren't just giving you a lump sum of money out of the goodness of their hearts. They have calculated, down to the penny, how much money they expect to make from you in interest payments over the entire life of the loan. That 30-year stream of interest is their product. It's their profit margin. If you suddenly pay off the entire loan in year 5, you've effectively cut off their profit stream for the next 25 years. The prepayment penalty is the bank's way of recouping some of that lost, anticipated profit. It's their insurance policy against you being too financially successful, too quickly. Now, not all prepayment penalties are created equal. They generally come in 2 flavors, hard and soft. A hard prepayment penalty is the most restrictive and, frankly, the most dangerous for a homeowner. It triggers if you pay off your loan early for any reason within a specific time frame, usually the first few years. This includes paying it off with a windfall of cash, refinancing with a different lender, or even selling your house. That's the critical part. Imagine you have to relocate for a new job 2 years after buying your home. You sell the house, and at the closing table, you discover that a chunk of your hard-earned equity is going straight to your old lender as a penalty for, well, moving on with your life. A soft prepayment penalty is a little more forgiving. It typically only applies if you pay off your loan by refinancing it with a new lender. The logic here is the bank is okay with you getting out of the loan, as long as you're not just jumping ship to their direct competitor for a better interest rate. If you sell the house, a soft penalty usually doesn't apply. This is far more common and manageable for the average homeowner. The calculation for the penalty itself can also vary. It might be a flat fee, a percentage of the remaining loan balance, say 2%, or it could be something like 6 months' worth of interest payments. On a large loan, any of these can amount to thousands or even tens of thousands of dollars. This all sounds pretty bleak, but here's where the law steps in to protect you. The 2008 financial crisis was a wake-up call. It exposed countless predatory lending practices, and prepayment penalties were high on that list. In response, Congress passed the Dodd-Frank Wall Street Reform and Consumer Protection Act. This sweeping legislation put some serious guardrails in place. Under today's federal law, prepayment penalties are heavily restricted for what are called qualified mortgages. A qualified mortgage is the gold standard. It's a loan that meets certain stable criteria, proving the lender made a good faith effort to determine you could actually afford to pay it back. The vast majority of conventional loans you'll encounter, loans eligible to be sold to Fannie Mae and Freddie Mac, as well as FHA, VA, and USDA loans, are qualified mortgages, and they are legally prohibited from having prepayment penalties. Let me say that again. For most standard home loans in America today, prepayment penalties are illegal. So where do you still find them? They typically appear in the world of non-qualified mortgages, or non-QM loans. These are loans for borrowers with unique financial situations that don't fit into the neat little boxes of traditional lending. Think of self-employed individuals with fluctuating income, real estate investors, or people with a recent credit event. For these types of loans, lenders take on a bit more risk, and they sometimes use a prepayment penalty as a way to hedge that risk. But even here, Dodd-Frank provides critical protections. If a lender offers you a non-QM loan with a prepayment penalty, the law says they must also offer you an alternative loan option without one. This gives you a choice. You might be offered a loan with a penalty that has a slightly lower interest rate, versus a loan with no penalty that has a slightly higher rate. The power is in your hands to decide which trade-off makes more sense for your long-term plans. Furthermore, even when a penalty is allowed, it can't last forever. The law generally limits the penalty period to the first 3 years of the loan, and the penalty amount itself is capped, often at 2% of the outstanding balance. The days of 10-year penalties buried in the fine print are largely over. So, how do you protect yourself? How do you make sure you don't walk into this trap? Simpler than you think. You just have to know where to look. When you first apply for a loan, you'll receive a document called the loan estimate. It's a standardized 3-page form designed to be easy to read. On the very first page, down in the loan terms section, there is a line item that says, plain as day, prepayment penalty. It will have a yes or no next to it, and if it's a yes, it will tell you the maximum penalty amount and how long it applies. Later in the process, right before you close, you'll receive the closing disclosure. This document mirrors the loan estimate. Check that same section again. Make sure nothing has changed. Ask your loan officer directly, does this loan have a prepayment penalty of any kind? Get a clear, unambiguous answer. This isn't a detail to be glossed over. This is a clause that could cost you thousands of dollars for the simple act of selling your own home. And that brings us to the end of our journey through the legal labyrinth of a U.S. mortgage. We've covered the 5 absolute cornerstones. We started with the 2 documents that form the heart of the agreement: the promissory note, which is your personal IOU to the bank, and the mortgage or deed of trust, the powerful document that ties that IOU to your physical property, giving the lender the right to take the house if you fail to pay. We demystified the escrow account, that mandatory savings account the lender controls to ensure your property taxes and homeowners insurance get paid on time, protecting their investment from tax liens and disasters. We uncovered your critical right to cure a default, the legal window of opportunity you have to fix a mistake, to make up for missed payments and stop a foreclosure before it truly begins. We confronted the lender's ultimate leverage, the acceleration clause, their power to demand the entire loan balance be paid immediately, which is the final terrifying step before the foreclosure process takes your home. And finally, we've exposed the prepayment penalty, the potential fee for getting out of your mortgage early. A reminder that this 30-year contract is a two-way business deal. From the first signature to the last payment, a mortgage is more than a loan. It's a complex legal relationship. Understanding these 5 pillars doesn't just make you a smarter borrower. It transforms you from a passive participant into an empowered homeowner. The goal was never to scare you with talk of foreclosure and penalties. The goal was to arm you with knowledge, because knowledge dispels fear. It replaces anxiety with confidence. When you walk into that closing, you won't just be signing a stack of papers you don't understand. You'll be executing a contract whose terms you know, whose risks you've weighed, and whose power you respect. This is likely the single largest financial commitment of your entire life. It's the foundation upon which you will build your future. And now you are ready to build it on solid ground.